Welcome back, America. I'm Hugh Hewitt. For 6 weeks, we've had incredible disruptions in the markets around America. So I thought I would call on our friend David Bahnsen, founder of the Bahnsen Group, also host of the Dividend Cafe, which I listen to most weekends, to get a little guidance because he was very calm and rational, as he usually is this past weekend. David, to give our audience a little bit of background for today, Dow went up 0.63%, the S&P went up 1%, the Nasdaq went up 1.23%, the Russell 2000 went up 1.5%, 10-year Treasury at 4.296, gold at 4,769, Bitcoin at 73,000, whatever that means, and crude at 98. Would you explain to our investors, not our traders, our investors, what position they ought to take in a time of tremendous world volatility and war?
They should have the same allocation during the volatility that they had before it and that they intend to have after it, because attempting to trade around it makes them not an investor. It makes them a trader. And the allocation, the investment plan they had, Hugh, was supposed to already account for the fact that we live in a fallen world that has wars, that has geopolitical uprisings, that has macroeconomic disruptions. So these things are not the exception. They are the rule. The particulars play out differently, but we can go back every single year of my career and every year that I've known you, Hugh, which is quite a few now, and there is something that disrupts the markets along the way. By the way, the S&P today got back to the price it was before the Iran war started. The peak to trough drop ended up being, so far, about 9.5%, which makes it not even an average drop for what the market does every single year.
All right, David Bahnsen, let's start. We have a new affiliate today, WHKY Talk Radio, 1290 AM and 102.3 FM in Hickory, North Carolina. There are always new affiliates. Let's start with the premise, too often ignored, that people don't know what an allocation means. Would you explain that to people, especially the Steelers fans?
Yes, for Steelers fans, which, by the way, Hugh, we just opened a new office in Pittsburgh, so I have to be very respectful now, much as I would be when we open in Cleveland. But here's the thing, Hugh. An allocation is nothing more than the totality of a portfolio, all the things you own. And so whether you intended it to be an allocation or not, you have one. And the question is how strategic, how purposeful that allocation, that sort of composition of the things you own to help you meet your financial goals is. And so when I refer to an allocation not changing based on news headlines, I'm saying that an investor has to take into account their income needs, their liquidity needs, their risk tolerance, their tax treatment, all of the various factors that play into what their portfolio ought to be. That's what an allocation is, and it's a process that people need to take seriously, but it is not one they should be changing day by day, week by week, and certainly not hour by hour.
Now, let's assume for a moment we've got some older people, and we do. Our target demo is 45 to 65. Older people are upset by news, and they get very antsy when markets start acting like this way. Reassure them, if that's the right word, that we've been there and done this before.
Well, it's very easy for me to reassure that we've been there, done this before, because the history is so completely clear. What I don't ever know is how a portfolio was aligned before. A 65-year-old that has 100% of their money in NVIDIA or 100% in the S&P 500 should be concerned. But in theory, if the portfolio was allocated the right way around their risk tolerance, around their income needs, with some long-term objective, the biggest thing that will mess up the portfolio is the investor, the owner of the portfolio, by trying to mess with it in the midst of bad timing. Think of people that panicked out a few weeks ago and said, you know what, this Iran thing could be the end of civilization, I'm jumping out. And then now this whole recovery has come. But it isn't just the Iran war. I think that there could be more volatility from it. It's every news event we've ever had. And what you have to do is know why you own public equities. Otherwise, you shouldn't own them. And I really believe people need to own high quality companies, but they have to understand philosophically, and this is why you and I are friends, because we agree on this type of thing. I don't own stocks because I believe all stocks always go up. I buy diversified specific companies because I believe in the profit motive, I believe in human action, and I believe in the profit making that comes from human beings adding value. That's what God made us to do, and that's what you're really investing in that is not disrupted by noise geopolitically.
Now, David, I just talked with the Senior Vice President of the American Petroleum Institute before you came on, because I have a feeling that if this goes on, new supply will come onto the market because it was $62, now it's $98, and sometimes it goes up to $120, and people in the Bakken and the Permian and other places are going to want to make money. That would lead me, if I were a trader, to buy Chevron and to buy American-based oil companies. Why would a trader be ill-advised to do that?
Well, for one thing, those stocks have already gone up meaningfully. Exxon over 40%, Chevron over 25%. We own both of them, and we've owned them for a long, long time. And so a lot of what people believe could be the case has already been priced in. So right now, for someone to come in and say, oh, this Chevron thing looks good, I'm going to buy it, guess what? You weren't the first person to think it. A bunch of people thought it 3 weeks ago and already bid the price up. So you're buying somebody else's profits. You're, in that case, becoming a price maker. You're not becoming a price taker. But let me say this, Hugh. I believe that the energy story has got to be understood as a long-term belief that we need oil and gas to power our various needs. The price you pay matters, but this is not a headline thing. Look, right now it's true, oil's 98, and it's true in the Permian. If they were to sell it, they'd be making a fortune. But you know what the December contract is for oil right now? It's 69. So the market expectation is still that oil prices are coming back down. I don't think they're going to where they were pre-war, but I do believe on the other side of the Strait of Hormuz opening is that you will see oil prices drop, and therefore trying to trade around a headline becomes a bad idea.
Now, a second thing I asked my API person is that there are companies like Halliburton and others that build the infrastructure that deliver oil and gas, and that I believe UAE and Saudi Arabia and other oil producers are going to diversify away from the Hormuz. Do you therefore look out 3, 4, 5 years and start investing in those?
The problem with the Halliburtons and Schlumbergers, both names that we've owned in the past, is they are very, very cyclical. Exxon and Chevron pay a dividend every year and manage to a sort of social contract that they will keep that dividend going. They kept it going through COVID, Hugh. They kept it going through the financial crisis. Exxon kept it going through Valdez, for Pete's sake. Schlumberger and Halliburton have proven to be very volatile companies, very pulled up and down around geopolitical events. So it's not what we own as dividend growth investors. There could be a story there, but you have to understand that those tailwinds then run into headwinds, and those are very cyclical companies, my friend.
This is why I don't invest for myself, because there are people like David who are out there doing it 24/7, 365, and they know a lot more than you do. Don't be a trader, be an investor, find someone to listen to. Bahnsen's coming back on the other side. Follow him on X at David Bahnsen. Welcome back, America. Hugh Hewitt with David Bahnsen. He is the founder of the Bahnsen Group, one of the great investment companies of the United States with offices all across the United States. I've known David for 30 plus years. He is not my client. I'm not his client. We're just friends. And David gives me truthful, direct answers about market issues, which is why I ask him on occasionally. David, I have 3 more questions for you. In the Dividend Cafe, your podcast, which I listened to this weekend, you said that we are expecting a good quarter in profits, and that's already priced into the market. Would you explain that for your new potential clients in Pittsburgh?
Yeah, the markets are expecting double-digit profit growth this year, and I still believe that they're going to get it. There may be certain companies that underperform expectations a little, others that outperform, but blended across the market. It's pretty rare, Hugh, to get 4 years in a row of double-digit profit growth. That's the expectation, and I happen to believe it fundamentally lines up. But the reason that doesn't necessarily mean you go out and buy stocks is they were already trading at 23 times earnings, which is a lot more than they normally trade at. So they're expensive relative to normal valuation, which means the profits could come in, but that was already priced in other words. And so I think that you have to be careful right now, be selective. You mentioned earlier the Russell 2000 was up big today. You know, the Russell 2000 never went down through the whole Iran war peak problems over the last 5 weeks. That's the small cap index. Smaller companies continue to do well, energy, some of the more defensive sectors. So really this year, before the war, during the war, and where we are now, Hugh, you see a market that's rotating into different leaders because the last couple of years, everything was about those big AI companies. That's not the story right now.
Well, that brings me to my second question. At the end of the Dividend Cafe, you promised another Dividend Cafe coming up soon about artificial intelligence. You and I spent a lot of Q4 talking about the AI trade and the AI boom and whether or not it was a trap. What are you going to say? What's the short version of what you're going to say on the next Dividend Cafe?
Yes, the short version of the Dividend Cafe that is coming out this Friday is that there are a lot of misunderstandings about where the AI thing is headed, and that investors getting caught into those misunderstandings take a lot of risk. There is disruption taking place, and then there is disruption that is not as economic as people think it is. And I really believe that the entire story from the beginning, and you and I talked about this about 6 months ago, and you know how much down Palantir is from when we talked back in October, November? And NVIDIA has not moved from when you and I talked. I was on your show the day of NVIDIA's earnings 2 quarters ago. It's at the same price now. Oracle is down 50%. There's a challenge right now in that there was a certain bubble, and now a lot of things are going to be revealed. And I'm going to talk about that this Friday at dividendcafe.com. But the meat on the bone is this, Hugh. The people are asking questions. Investors are asking questions about where the money is going to be made. It isn't enough just to have a hype. What are the specifics for profit making from this? And I think certain stories are going to play out well and other stories are not.
Now, you and I are both Californians, sort of. We're not longer any California. I'm not, at least. I'm not a Californian. I'm a Virginian. But we lived there for a long time, and it's tragic what's happened to the state. Does the election have anything to do with the fundamentals of living and investing in California, maybe building a company there?
The gubernatorial election this November?
Right. Yeah.
I wish it did, Hugh. I think you know as well as I do that what you have in California is a byproduct of several decades of a cultural shift that even if more voters get frustrated and more voters get upset, and you've seen kind of, like when Virginia had a good governor 4 years ago, voters got sick of things. But Virginia's still a pretty bluish state. California is so blue that even with the mismanagement, even with the horrible things that have taken place with their supermajority and with Governor Newsom, the registration advantage and the lack of any viable Republican, it doesn't make it a winnable state yet. You need the culture to shift before you can see the politics shift.
As a matter of a place to do business, do you expect them to still, we have less than a minute, still lose business after business fleeing California no matter who wins?
Yes, I do, and it's not just the large companies that leave that make the headlines. Everyone talking about the big S&P type companies that go. There's a big splash around that. The biggest story since COVID is all the startups in Silicon Valley that said, never mind, we're going to Denver, we're going to Utah, we're going to Texas. It's small businesses that are leaving like crazy, but the big companies get the headlines.
David Bahnsen, CEO, founder of the Bahnsen Group, thank you for joining me. Follow David on X at David Bahnsen, Bahnsen. And if you don't have an investor, find the Bahnsen Group nearest you, especially folks who listen on WPIT. You can trust him. Even though he's opening up in Pittsburgh, you can still trust him.